If you've started shopping for life insurance, you've probably noticed something confusing. Two policies promise to pay your family if you die, yet one can cost 10 times more than the other every single month. The cheaper one is usually term life. The pricier one is usually whole life. On the surface, they sound similar, so why the enormous gap? The honest answer is that you're not really buying the same thing. Term and whole life are built differently, and your premium flows to very different places inside each one. In this video, we're going to follow the dollar. We'll trace where your money actually goes in a term policy versus a whole life policy, why one builds something called cash value and the other doesn't, and what people mean by the phrase, buy term and invest the difference. We're not here to sell you on either choice. The goal is simply to help you understand the machinery so you can ask better questions. Keep in mind that products, prices, and rules vary by state, by insurer, and by your own health and age, so treat everything here as general education, not a recommendation for your situation. Let's start with term life because it's the simpler of the two. Term life insurance covers you for a set period, a term, which is commonly 10, 20, or 30 years. You pick the length and the amount of coverage, often called the death benefit. If you pass away during that term, the insurer pays the death benefit to the people you named. If you outlive the term, the coverage ends and there's no payout. That's it. Because of this simplicity, almost all of your premium goes toward one job, paying for the pure cost of insuring your life during those years, plus the insurer's expenses and a margin. There's no savings account attached, no investment bucket, nothing that builds up over time. You're essentially renting protection for a defined window. That focus is exactly why term tends to be inexpensive when you're young and healthy. You're buying a large amount of coverage for a relatively small monthly cost, but only for as long as the term lasts. The trade-off is that the price typically jumps if you try to renew or buy a new policy later in life, when you're older and statistically more likely to pass away. Whole life insurance is a different animal. As the name suggests, it's designed to cover you for your entire life, not just a fixed term, as long as you keep paying the required premiums. Because the insurer expects to pay a death benefit eventually rather than possibly never, that permanent guarantee costs more. That eventual payout assumes the policy stays in force. Many whole life policies are surrendered or lapse before death, in which case no death benefit is paid. But the higher premium isn't only buying lifelong coverage. Whole life is a bundled product. Part of your payment covers the insurance itself, part covers the insurer's costs and commissions, and part is set aside into a feature called cash value. Cash value is a savings-like component inside the policy that grows slowly over time, usually at a modest guaranteed rate, and sometimes with non-guaranteed dividends on top, depending on the insurer and policy type. You can often borrow against this cash value or withdraw from it later, though doing so has rules and consequences, including potentially reducing the death benefit. So when someone asks why whole life costs so much more, the layered answer is permanent coverage, higher built-in costs, and the fact that you're funding that cash value bucket with every payment, especially in the early years. Now let's literally split the dollar. Picture a single premium payment going into each type of policy. In a term policy, that dollar is mostly going to one destination: the cost of covering your death benefit for the period, with a slice for the insurer's expenses and profit. It's lean by design. In a whole life policy, that same dollar gets divided. A portion pays the underlying cost of insurance, which actually rises as you age even though your premium stays level. A portion covers administrative fees and the agent's commission, which is often front-loaded, meaning it's heaviest in the first years. And whatever remains flows into your cash value. This is why whole life cash value tends to grow very slowly at first and only picks up momentum after many years, sometimes a decade or more. In the early period, a large share of your premium is being eaten by costs and commissions before much lands in the cash value at all. Understanding this split matters, because it explains both why whole life is expensive and why its savings component is not a fast or high-return investment. It's a slow, steady, conservative one with insurance wrapped around it. This brings us to a phrase you'll hear constantly in life insurance debates. Buy term and invest the difference. The logic goes like this. Term insurance gives you the same death benefit for a much lower premium. So instead of paying for expensive whole life, you buy cheaper term and take the money you saved, the difference, and invest it yourself in something like a retirement account or index fund. The idea is that over decades, a separately invested fund might grow faster than a conservative cash value, while still leaving your family protected during the years they depend on your income. It's a reasonable framework, and it's popular for good reasons. But it's not automatically the right answer for everyone, and it comes with conditions. It only works if you actually invest the difference consistently rather than spending it, and if you're comfortable with the ups and downs of market-based investing. It also assumes your need for coverage is temporary, ending around the time you've built enough savings. We're laying out the logic, not endorsing it, because whether it fits depends entirely on your discipline, your timeline, and your goals. It's worth hearing what each side genuinely argues, neutrally. Supporters of term plus separate investing point to lower costs, transparency, and flexibility. You see exactly what you pay for, you control your own investments, and your coverage can match the years your family most needs it. Critics of that approach note that many people never actually invest the savings. That term coverage expires and can become very expensive or hard to qualify for later. And that whole life offers things term doesn't. A guaranteed payout no matter when you die, a forced savings habit, level premiums for life, and certain potential tax and estate planning features that can matter for specific situations. Whole life can also appeal to people who want lifelong coverage for a dependent who will always need support, or who have estate considerations. Neither side is lying. They're optimizing for different priorities and different people. The mistake is treating one as universally superior. The right framing isn't which is best, but which structure fits this particular person's needs, budget, time horizon, and comfort with risk. And that genuinely varies from one household to the next. Before signing anything, a few questions can cut through the sales pressure on either side. First, how long do I actually need coverage? If it's only until the kids are grown or the mortgage is paid, that points one direction. If it's truly for life, that points another. Second, what is this premium buying, and how is it split between insurance, fees, and any savings component? Ask for an illustration and look at how the cash value grows, especially in the early years, and what's guaranteed versus merely projected. Third, what happens if I can't keep paying? Term simply lapses, but a permanent policy may have surrender charges or shrinking value. Fourth, am I being shown an honest comparison or just one product? And finally, how does my health, age, and state affect what I'm being quoted? Premiums and available products differ from person to person and place to place. There's no shame in asking an insurer or agent to slow down and explain. A responsible professional will welcome these questions rather than rush past them, and getting clear answers in writing protects you. So where does the premium actually go? In term life, almost all of it buys pure, temporary death benefit protection at a relatively low cost, with nothing built up to take back. In whole life, your larger premium is split among the cost of permanent insurance, the insurer's fees and commissions, and a slow-growing cash value you can potentially access later. Buy term and invest the difference is a sound framework for some people, but only if they truly invest the savings and their need for coverage is temporary. The bigger lesson is that the price gap isn't a trick. It reflects two genuinely different products doing different jobs. Cheaper doesn't automatically mean better, and more expensive doesn't automatically mean more value. What matters is matching the structure to your real situation. How long you need coverage, what you can afford, and how you feel about managing your own investments. Take your time, compare honest illustrations, and verify any numbers. Remember that prices, products, and rules vary by state, insurer, and individual, so this is general information, not a recommendation. To find what fits you, talk with a licensed agent and check official sources before you decide.